Good morning, at least for me, and welcome to my Counting 1110 review for final on Chapter 8. This is going to be part 1 of what I think will be a 3-part series. And what we're going to talk about in Chapter 8 is cash and how to do the accounting for cash. Anytime that you have a discussion on cash is a great time to have a discussion on internal controls too. Cash is universally desirable and unmarked. It's hard to say whose 20 is in your pocket, yours or someone else's, once it's in your pocket. The discussion we're going to have on internal controls rightfully relates to all assets. But since cash is the most liquid and perhaps the most desirable, we choose to have it with cash. Let's first mention the overall reaching internal control, or the overall reaching goals of internal controls. Overreaching goals of internal control apply to all assets. The first goal is they want to safeguard your assets, protect them from harm, adequately insure them, make sure they end up staying yours. Another overreaching goal is to promote adherence to company policies. All the internal controls in the world won't work if people aren't doing what they're supposed to do. They're also supposed to promote efficiency. Let's do things in the best way we can. Sometimes we have audits just to see if we're doing things as quickly and as effectively as possible. And finally, an overreaching goal is to ensure accurate record keeping. Outsiders depend on the financial statements that we give to them, and it's of utmost importance that they be accurate. Internal controls were lacking a little bit, one could say, and in the last several years we've had some pretty big failures. As a result of those failures, Congress enacted a law by 2 senators. The names of the law's called Sarbanes, can't spell today, Sarbanes-Oxley Act, and accountants refer to it affectionately as SOX. Sarbanes-Oxley is enacted by Congress, and it has a few components to it that are important to us. First of all, they say management is responsible for internal controls and financial reporting, and they must issue a report that says they have internal controls in place and that they're being utilized and that they're efficiently and effectively safeguarding assets and doing all the things overreaching goals say so. Because it is, after all, management's responsibility. And this report is included in their annual filing to the Securities and Exchange Commission. This act also requires that the internal controls be evaluated and reported on by the outside auditing firm for public companies, so that you actually have to have a separate audit on your internal controls. This act also created the Public Company Accounting Oversight Board, abbreviated PCAOB, Public Company Accounting Oversight Board. And this board oversees and controls external auditors. Since external auditors seem to be the problem in our last big round of failures, a board was created to make sure that internal control issues and reviews are being done to certain standards, and this board oversees that. Finally, this board, I guess it's not finally, limits the amount of work that a public firm, the outside CPA firm, can do for their clients beyond the audit. Some people say Arthur Andersen, who signed both the audit for WorldCom and Enron, was making $40,000 a day in other services they were providing to Enron, and that they in fact were not independent anymore because of that. And this act has teeth in it. It has stiff penalties. prison terms of 20 to 25 years if you get caught for fraud, if you get caught for gross negligence. And those years are served in prison, and fines up to $250,000. So if you are in management and you sign the report, and in fact you've committed fraud, or if you're the outside auditing firm and in fact you've committed fraud, you personally and individually could be sent to prison, and you're going to suffer with a big fine. So internal controls have become an important part of the function of accounting. Let's look at 5 components of internal controls. Notice the cute little acronym of the first letters of each of these: C, R, I, M, and E. Crime. Who says accountants don't have a sense of humor? Let's talk about the first one: control procedures. One of the important components of internal control is the control you build into your procedures. Care should be given to hire competent and ethical employees. Another control feature is the way that you assign responsibilities. The responsibilities should be assigned in such a way that if something goes wrong, you can say exactly who is responsible for it. Take, for example, cash boxes at grocery stores. When someone who's using a cash register goes to break, their cash box goes with them because they are responsible for the contents of that. Another important control procedure is to separate responsibilities in such a way that one person's work is a check on another. One example of this is separating the accounting for assets from the custody of assets. Someone who can actually touch inventory shouldn't do the accounting for it. Another important control procedure is to have a regular audit by an outside accounting firm and by external auditors to make sure that the controls that you have in place are being followed. Another good control feature is how you use documents. Checks and deposit slips and sales receipts should be numbered and accounted for. Another component of control could also be electronics. The little tags on merchandise that set off alarms if you leave a store without having paid for it. Those electronic devices are another form of internal control. And finally, e-commerce. E-commerce brings a whole new area of control procedures necessary to have the components of internal control in place. You need to be sure that your system can't be hacked into and manipulated by people who don't have a responsibility or authority to be in there. Risk management. Let's move on to number 2. Your internal controls, one of your internal controls would be to identify where your biggest risks are and then build controls around it. I used to work for a jewelry store that held a large quantity of large diamonds. I was in charge of the accounting for the large diamonds, and I never even got to touch them. What a shame. Wouldn't you see? Can't you see? if you build your controls around your risk correctly, you can really mitigate problems that can arise. Another component of internal control would be your information systems. Boy, it's early. You need to control who has access to your accounting records and your information systems, making sure that only people with approval are allowed to authorize transactions, and enter places of your information system that they're allowed. Who's breaking into your personnel records? Vital information is kept there, and the controls on that need to be enough so that your employees' identities aren't compromised. They also need to have controls built into your information systems that ensure accounting accurate information is being presented. No fictitious transactions are being recorded. No one's manipulating funds in a way that hides things. All of these are very important. Once you have good internal controls in place, you must monitor them. We have internal auditors whose job it is to create internal controls and make sure the company uses the controls that are in place. And we have external auditors who come in and make sure the internal auditors are doing their job. Makes me smile. Committee to watch the committee. And the external auditors also make sure that there's adherence to generally accepted accounting principles going on. Finally, one of the last 5 components of internal control is what we call the tone at the top. Is top management behaving in an efficient fashion? Are they walking their talk? How can you expect employees to behave if upper management isn't? In Chapter 8, then, we're going to observe some of these controls in place as they relate to the accounting for cash. There's only 2 places you're susceptible to cash. The beginning balance is probably pretty safe. It's in a checking account at a bank, insured. Where you're susceptible is in cash receipts, money coming in, and in cash disbursements, money going out. Chapter 8, we look at ways to spot see how internal controls can be used in both of these areas, and then on the bank account itself. A quick discussion on internal controls for cash receipts and disbursements, and we'll move on to the rest of the chapter. Some internal controls you could use for cash would be to use electronic devices whenever possible. Have a cash register that keeps track of what sales were, I guess, for the day, and how much cash should be in the drawer. If they're really good, they can even keep track of how much you should have in cash, how much you should have in credit card receipts, and how much you should have in checks. You should also use pre-numbered documents, so your deposit slips perhaps are numbered. For sure, your sales documents are numbered, and that somebody checks to make sure that none are missing. You should also separate custody from cash from possession. The person that handles cash should not be making entries into the general ledger system. And finally, you should assign responsibilities to people so that if a cash drawer comes up short, you can say who was responsible for that cash drawer. These are the kind of internal controls that would apply to cash receipts. How about a few quick ones? for internal controls that would apply to cash disbursements. And they're going to be similar to cash receipts, but there'll be a few more of them. Most thefts happen on the disbursement side of things, not on the receipt side of things. You should always separate duties in such a way that the work of one person acts as a check on another. Your book talked about a voucher system, which was very good, doing those kind of things. There should be support for transactions. The support should include good documentation. There should be invoices, receiving reports, and purchase orders. Should have pre-numbered checks so that you can account for any that might come up missing. You always need to know certain things. You need to know when things are ordered, that was approved by a person in a position to have authority to do so, and that goods that you ordered were received and in good shape, and that they were what was ordered and what was needed. And then you need to make sure that when you pay for it, you pay for the correct amount, the amount that was agreed to. These are some internal controls that relate to cash disbursements that should be readily apparent to you. We're going to have a discussion on some more specific internal controls. I cannot spell today, as they relate to cash and a few other PENCAS, petty cash, checking account, a few other things. So let's end this discussion of overall internal controls and this first introduction to how they might relate to cash, and move on to some other topics in Chapter 8. Thanks for joining me. Sorry this one was a little bit boring. It's always boring to just talk and not analyze and use numbers, isn't it? Thanks for your patience. Let's move on already.